Hello and welcome everybody. In this short update, we'll be taking a look at the primary issues affecting investment markets at the moment, from Trump's tariffs to the Israel-Iran conflict. We'll then be taking a look through some of the investment strategy considerations in light of these events. So, geopolitical issues are dominant markets at the moment, and there's no doubt that the main headlines are Trump's tariffs and now the Israel-Iran conflict. Starting off with tariffs, a lot has happened since the start of the year. The main events being the US-China trade war and the Liberation Day tariffs from the US, which saw them implement blanket tariffs on a wide array of nations. Equities sold off on the back of this news, especially after the Liberation Day tariffs on the 2nd of April. And since then, we've seen a de-escalation in rhetoric with a 90-day pause in the higher tariff rates imposed as part of the Liberation Day tariffs. The market has reacted quite well to this, and the S&P 500 is almost back to record highs now. We believe, though we're not in the clear yet, as the 90-day pause is expected to end in July. However, Trump has shown that he is willing to back down if it looks like there will be a substantial detrimental impact on US markets. The tariffs are expected to cause some economic stress over the latter half of this year. We've already seen this in play in April in the UK with a GDP contraction of 0.3% as firms were hit by tariff hikes and also tax rises as well. That said, the US-UK trade deal provides some hope, but more deals are needed to negate global economic impacts, especially with larger regions such as China and the EU. And finally, Trump has expressed a wish to devalue the US dollar to make US exports more attractive to other countries. The dollar has already devalued considerably this year following the tariffs, and it'll be interesting to see whether this continues. Possibly the more topical issue affecting markets at the moment is the Israel-Iran conflict. There was a significant development over the weekend as the US bombed several of Iran's key nuclear research facilities. As we can see on the chart at the bottom there, we've already seen an increase in oil prices due to the increasing tensions over the last few weeks. But where we go from here really depends on Iran's reaction. So a significant reaction from Iran, which sees them attempt to shut the Strait of Hormuz, will cause a significant oil supply shock, and that will cause significant price increases as well. Under such a scenario, we can expect to see a significant market sell-off and also implications for the real economies through rising inflation. On the other end of the spectrum, though, another scenario involves a de-escalation in tensions where Iran vows to decommission its nuclear research program, and this will likely cause a negligible impact on global markets. Possibly a more likely scenario, sort of a middle-of-the-road scenario, which sees Iran's oil output severely impacted, or at least impacted, will affect oil prices, but not as much as the event where we see a closure of the Strait of Hormuz. But all in all, the Israel-Iran conflict has the ability to significantly impact markets, but the extent to which all depends on Iran's reaction to the US strikes, essentially. So what are the investment strategy considerations under the current environment? Here we've outlined three broad considerations that will impact most well-diversified investors. The first one we've outlined here is currency hedging. Currency movements can have quite a profound impact on portfolio returns, and we've seen this in play over 2025 so far, where the US dollar has devalued considerably against sterling amidst the tariff situation. For sterling investors, unhedged US equities have lagged hedged US equities by around 7% over the year so far. Although the US market has now produced positive returns in local currency terms over the year so far, due to this currency effect, unhedged investors will be sitting on a loss of around 4% still as of today. And as mentioned on the previous slide, President Trump has vowed to devalue the US dollar in order to make the US more competitive in terms of trade. And we believe investors should now be considering their level of currency hedging due to this. The exact level of currency hedging will, of course, be dependent on the investor, but no currency hedging at all may expose your portfolios to some unintended risk. A reasonable level may be somewhere around 50% for investors that would like to take a neutral approach. And the second consideration we've outlined here is diversification across asset classes. And this is generally recommended in most cases anyway, but especially in times of uncertainty. The ongoing risks may cause a flight to quality, first of all. Safer assets such as fixed income and cash may outperform risk assets in the short term. Also, the Israel-Iran conflict may favour commodities, especially if oil supply is affected, and particularly if access to the Strait of Hormuz is blocked in any way. We've already seen reports of increased shipping costs as some tankers have now decided to revert to other routes. Also, a reduction in oil supply could drive up oil prices, which could exacerbate inflationary issues that we've already seen. Some form of inflation exposure in your portfolio could be beneficial in such instances. Central banks will need to balance these inflationary pressures if they materialise with the slower economic growth that we've seen due to the tariffs. And in the absence of any escalation in the Israel-Iran conflict, tariffs will likely remain the key driver here, as they will cause that slowing in economic growth over the latter half of this year. This may mean that we see more rate cuts, which could lead to capital appreciation for fixed income assets, particularly across the short end of the curve. However, fiscal pressures on governments may mean that on the longer end of the curve, yields may be less likely to fall. In terms of the final strategy consideration from us today, diversification within equities and other risk assets may prove to be beneficial. Across the short term, US equities may benefit from the Israel-Iran conflict relative to other developed regions. Europe in particular will be more exposed to higher imported energy costs should we see that oil shock scenario. Energy stocks in particular actually will be the beneficiaries under such a scenario. But over the medium term, we see merit in diversification across regions. US equity valuations remain at historical highs still, with high concentration to a handful of very large technology stocks. And this makes the medium-term view somewhat less attractive to us and makes the market a little bit more susceptible to shocks. And therefore, we see merit in diversification across regions in the medium term especially. And that wraps up all of our considerations. So thank you for listening to this session. I hope it has given you one or two things to think about in terms of your portfolio. But if you have any questions or if you would like to discuss any of these issues in greater detail, please do get in touch with us. But in the meantime, have a great rest of your day and goodbye.